Hello, and you're welcome to Global Business Insights, where we try and look a little deeper at the latest business headlines. Last Friday, Federal Reserve Bank of Atlanta President Raphael Bostic said he now expected just one interest rate cut this year instead of the two rate cuts he had initially forecasted. He's citing the persistent inflation and stronger than anticipated economic data as reasons for his revision. Stocks are still basking in the optimism of looming cuts, also with better economic growth forecasts. And when you add the AI hype fueled recently by an NVIDIA conference, you can understand why sentiment is somewhat upbeat, even though I can see the futures are down as we speak this morning. But we also have a cloud of unrelenting geo-economic conflicts, whether related to the Russia-Ukraine crisis or Israel-Gaza front. Data definitely is going to matter. This week on the data front, we get the Chicago Fed National Activity Index and the U.S. new home sales for February also out today, and more Fed official speeches. The German retail sales and US GDP analyzed growth numbers for Q4, that'll be out on Thursday. Q4 GDP in the US is expected to expand 3.4%. And on Friday, the US Core Personal Consumption Expenditure Index, as the PCE price index, is seen rising 0.3%, that's the month on month, in February, which would keep the annual core pace at 2.8%. That could spring a surprise depending on what we eventually see. Over the weekend, China announced new guidelines to phase out use of US microprocessors from Intel and AMD in government PCs and servers as Beijing accelerates its bid to replace foreign technology with homegrown solutions. Still on China, the IMF boss Kristalina Georgieva just said that China needs reforms to further open its markets to realize potential for growth. Premier Li Qiang also told a forum of global CEOs that it's carefully studying issues of market access and may soon issue new regulations in these areas. We'll have to wait and see. On central banks, Ghana is expected to decide to hold interest rates at its policy meeting today at about 11 GMT. We'll get the speech, while Nigeria will conclude its own meeting, which started today, will conclude tomorrow, expected to hike rates. And we just got Singapore inflation up 3.6% in February from a year earlier. Goldman Sachs, in an updated forecast over the weekend, sees commodities advancing this year as major central banks move to reduce interest rates, which will support industrial and consumer demand. Demand for copper, aluminium, gold, and oil products may climb, and returns will improve as manufacturing recovers despite persisting geopolitical risks. Also warning investors to be selective as gains wouldn't be universal. At year end, Goldman is saying price forecast for copper seen at $10,000 a ton, aluminium at $2,600 a ton, and gold at $2,300 an ounce. Kristalina Georgieva, IMF Managing Director, says China faces a fork in the road on whether to stick to policies that have worked in the past or update its policies for a new era of high-quality growth, which seems to echo the direction of thinking of Chinese policymakers. But China has other things on its mind as it comes out with new guidelines to block use of Intel and AMD chips, coming alongside measures to sideline Microsoft's Windows operating system and foreign-made database software in favor of domestic options. China is building domestic substitutes for foreign technology in response to moves in the US as tensions increase between the two countries. While many emerging economies are doing their best to be neutral in view of the ongoing tensions, it's important that countries proactively anticipate the weaponization of trade flows in sensitive materials to further their own country interests, which will result in a recalibration or redefinition of what we understand to be globalization. African economies especially have to reconsider how they are poorly positioned in the technology value chain and take advantage of vast growing markets that some of them have to accelerate more value added production locally. India has realized that it must produce chips locally. China is looking at everything from the upstream design, challenging the likes of NVIDIA, to the more downstream devices, challenging Apple. The answer is not a blanket nationalization, but deliberate skill building and targeted industry support. In China, analysts see that they have at least about $91 billion from 2023 to 2027 to spend in replacing the IT infrastructure in government and major industries. This will attract innovators willing to develop and use more local components. Irrespective of who wins the US election, there is bipartisan concern to reduce vulnerabilities in the core technology space, so we can expect the trend of tech wars to intensify. Africa as a continent also needs an updated and more aggressive continental technology initiative in response to these trends as it moves more aggressively to address basic infrastructure gaps. In Ghana, the 117th Monetary Policy Meeting of the Apex Bank decides on rates today. Governor Ernest Addison will present the decision on MPC's deliberations around 11 a.m. and most analysts expect they will keep interest rates unchanged at 29% as they want to bring down inflation driven by depreciation in the cedi. The Bank of Ghana reduced their policy rate by 100 basis points to 29% at the January meeting, also the first rate cut since 2021. Inflation in Ghana has been falling, dropping to 23.2% in February compared to 23.5% in January, but well above the central bank's target of 6 to 10%. The central bank see inflation at between 13% and 17% before falling further by end of 2025 towards its medium-term target range of 6 to 10%. The IMF, which recently agreed a tranche of $600 million to Ghana under the country's 3-year bailout program, has warned against further loosening as Ghana needs to bring inflation down. Ghana still, however, enjoys a positive real rate of 5.8%. That's after adjusting their rate for inflation. Governor Ernest Addison, as it presents, we expect that the last rate cut was due to the downward trend of inflation, and they will still want to watch the impact of that rate cut on especially the cedi. Ghana's composite PMI had slipped into a contraction, that is 48.4 points in January of 2024, but it increased. February composite PMI increased to 50.2 points. The cedi has also since declined further after the previous rate cut, and the central bank will want to see the currency stabilized. In Nigeria, the Central Bank of Nigeria, that's the Monetary Policy Committee, will start their own monetary policy meeting today and end tomorrow. Expectations are that we see another rate hike. On Friday, we did bring you a preview of the meeting. On Monday, Nigeria Monetary Policy Committee meets, but first, some background. On Wednesday, the Deputy Governor of the Economic Policy Directorate of the Central Bank, Mohammed Sani Abdullahi, also a member of the MPC, said headline inflation will go up to 32.63% in March, 33.56% in April, before coming down to 33.04% in May. This was at the CTC Macro Conference in London. Sani Abdullahi was one of the hawks on the MPC. He voted for 400 basis points hike with 6 other members at the last meeting. 3 MPC members voted for 300 basis points and just 1 voted 100 basis points. The central bank governor wanted 425 basis points, while another voted for a 450 basis point hike. So of the 12, 8 wanted 400 basis points or more, which looks hawkish. The Central Bank of Nigeria also announced that all valid foreign exchange backlogs owed various sectors of the economy had now been settled. The central bank is targeting inflation dropping to 21.4% by the end of the year, with the focus on building confidence and strategic partnerships with investors. A near-term target of tightening credit through higher rates and a higher cash reserve ratio, and reducing borrowing for consumption and increasing savings, also seeking to bring down bank liquidity and aggregate demand to reduce money supply, also bringing inflation down. Most importantly, aiming to achieve a positive real interest rate. The central bank have also unified exchange rate windows, liberalized the FX markets, and reformed the bureau de change segment. Banks were also instructed to limit the net open position of their foreign currency assets and liabilities to 20% of shareholders' funds. The bank also lifting the daily cap on remunerable standing deposit facility, with ongoing plans to recapitalize banks to support the $1 trillion GDP economy. What will they do on Tuesday with real interest rates? That's 31.7 minus 22.75 at minus 8.95, and with the bank expecting inflation to still go up to 33.56, that would be minus 10.81% in terms of where real interest rate lies. I would think 400 to 450 basis points can be ruled out. But also noting the latest PMI showed a huge hit as February PMI started sinking. Poor electricity supply will hurt March PMIs even more. So my best guess is maybe another 400 basis points, or maybe slightly lower than that, as they watch for the impact on inflation and what happens with the economy. Oil prices rose in early Asian trading on concerns over tighter global supply brought about by escalating global conflicts. Brent Standard just under $86 per barrel, slightly up this morning. Looking at Asian stocks, they are mostly down, as it looks like the market is seeking for direction in the absence of any major catalyst. We got some inflation data from Singapore, just like we said, just up 3.6% in February from a year earlier. That was the highest read since last July. That's 2023. Australia's inflation numbers out on Wednesday. Tokyo inflation data out on Friday. Nikkei 225 closing 1.16% down. Hang Seng also down 0.28%. Shanghai Composite, Shenzhen Composite, both are also down 0.71% and 1.49% respectively. The South Korean Kospi also down 0.4%. European stocks also set to start the week on a mixed note. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Please share and kindly follow on Facebook and LinkedIn. Subscribe on YouTube and X. Thank you very much for watching and following. Bye-bye.